De Beers has met its match and they're not playing. Gen Z seems epically uninterested in diamonds and it's caused a 20% drop in their value. In late September at the Beers Botswana offices, a significant shift occurred. The world's top diamond buyers, usually bound to buy their full allocations at fixed prices by De Beers, were unexpectedly given the choice to buy nothing. This change reflects the current state of the diamond market, where prices are dropping globally. As a result, De Beers, once a diamond monopoly, is offering more flexibility, lifting previous restrictions entirely. This move is part of a broader effort in the diamond industry to address the sharp decline in diamond prices this year. The decrease in consumer demand has led to excess inventory, prompting companies to take drastic measures. Alrosa PGSA, a Russian mining company and a major competitor of De Beers, suspended all sales for 2 months. Additionally, India's diamond market, a key player in cutting and trading, voluntarily paused its imports. During the latest sale, De Beers buyers, mainly from India and Antwerp, embraced this new flexibility. They purchased only 80 million worth of uncut diamonds, far below the typical 400 or 500 million that De Beers expects at such events. Excluding the early pandemic period when sales stopped, this was De Beers' smallest sale since they've been disclosing sales since 2016. The rapid and intense downturn in the diamond prices took many by surprise, considering the industry's success through the global pandemic. During that time, homebound consumers increased their spending on diamond jewelry and other luxury diamonds. However, as economies reopened, diamond dwindled, leaving traders with excess, overpriced inventory. The initial slowdown quickly escalated into a significant drop. The U.S., the largest industry's largest market, experienced economic instability due to rising inflation. Additionally, China, a crucial emerging market, faced a real estate crisis that weakened consumer confidence. Complicating matters, this lab-grown diamond sector began getting significant traction in certain markets. Regarding price trends, wholesale polished diamond prices have fallen roughly 20% this year. It's huge. This decline has had an even more dramatic impact on rough or uncut diamonds, with prices dropping up to 35%, particularly during the late summer and early autumn. In response, the industry drastically reduced supply, a move that now appears to be effective. Recent smaller tender sales at auctions have seen price increases of 5 to 10% due to emerging shortages of some stones. With the anticipated reopening of Indian factories after extended Diwali closures, there's a growing optimism that the industry may have weathered the storm and the worst of the crisis. Anish Agrawal, a partner at GenZ, a specialist diamond advisory firm, observed that the diamond industry has effectively taken measures to stabilize the market, which should help rebuild confidence. The drop in diamond prices aligns with a broader downturn in the luxury sector. LVMH, Moet, Hennessy, Louis Vuitton, SE, and luxury designer conglomerates, 75 brands including Christian Dior, Bulgari, has seen its stock value decrease by over 100 billion since mid-April. The decline is attributed to less than expected recovery in China and a decrease in demand from U.S. consumers. Similarly, Richemont, the owner of Cartier, reported a surprising fall in earnings due to a drop in luxury watch sales and a general pullback in high-end consumer spending. The diamond industry, however, has unique characteristics that make it particularly susceptible to reduced consumer demand. De Beers, for instance, organizes 10 sales annually where buyers typically have to accept both the price and the quantity of the diamonds offered. When diamond prices rise, as they did the past 2 years, buyers often speculate, purchasing unprofitable stones in the hope that continued price increases will lead to future profits. Additionally, large purchases can lead to larger future allocations, a practice known as buying for position. Such practices can create speculative bubbles that burst when consumer demand drops and polished diamond inventories accumulate. In response to the current situation, Alrosa halted diamond sales for 2 months, and the Indian diamond industry imposed an import shortage until mid-December. De Beers has allowed its customers to decline all purchases for the last 2 years of the year without affecting their future allocations. Although it's common for dominant diamond buyers to reduce supply or permit purchase refusals when demand falls, the extent and rapidity and how rapid of the recent combined actions are exceptionally unusual, typically only seen during major crises like the pandemic. While diamond prices have stabilized and are even increasing in some regions, the upcoming holiday season, stretching from Thanksgiving to Chinese New Year, will be critical. The market's future will largely depend on how major miners, who currently hold substantial stocks of unsold gems, reintroduce these into the market. Additionally, there's ongoing uncertainty in the industry and the underlying cause of the recent slowdown. It's unclear whether this decline is primarily due to broader economic challenges or if it reflects a more significant shift in consumer preferences. The rise of lab-grown diamonds, and you can't even tell, I've looked at a lot of them, in certain markets is a notable factor. Moreover, there are concerns about whether Gen Z consumers perceive diamonds in the same light as previous generations, which could impact future demand. So, the moral of the story is, if you're going to get engaged, if you need diamonds, now's the time. You should be buying diamonds from now. That's the moral of the story. It's a little bit cheaper. It's always expensive, but anyways, I hope you liked it. If you like it, put some comments, and hope that was informative to anyone that's in the diamond market.